Hello, everyone. Thank you for joining us today for another episode of Two Economists and a Lender, where we take a deep dive into the most important economic issues facing agriculture. I'm your host, Carly Jacobson. David Widmar and Brent Gloy are back with us from Agricultural Economic Insights, along with our own lender expert, Chad Thue, an officer out of South Dakota. So in today's episode, we're going to discuss the importance of having a capital expenditure plan and how to think through the process of creating and tips for maintaining this plan across those multiple years. With no further ado, Brent, why don't you kick us off?
Thank you, Carly. Great to see you again this month. This is a topic, capital expenditure plan, that I think we talk about a lot, and there's good reasons for that. Capital expenditures are really important to your farm and to your financial future, and so I think it's one of the most important things that we can plan around. And for instance, I always say that honestly, it's probably not going to make a huge difference over the long term, which brand of seed corn you buy, or even whether you exactly what your crop mix is. But these capital investment decisions that you make will be a huge determinant of the long-term financial picture of your farming business. And one thing is pretty clear when we look at kind of national data, and which I've got a chart here. One of the things pretty clear is these capital expenditures tend to bounce around. This is at the sector level of the U.S. farm economy, but oftentimes they're right in this kind of $30 billion area, and then occasionally they really jump up. And if you look at that chart, that time when those things really jumped up, when did that occur? Well, it was roughly with the really last time in the farm sector that we had really, really high profits. And I think this year, USDA's forecast for capital expenditures looks to be pretty flat. But my bet is that when they reforecast that number is going to be much, much higher. And there's a reason for it. I think the financial conditions of the farm economy today are as good as we have seen for a number of years. And so I expect, this fall and next spring to see some really large capital expenditures made by farmers. And there's nothing wrong with that. But I think it's really important. This is a good time to plan, and it's a good time to think those through carefully, because I think at the end of this year, what's going to happen is that a lot of farmers are going to have their accountant come to them and tell them that you had a really good year, and if you have any capital expenditure needs, now is the time. And as I said, there's nothing wrong with that, but we want to make sure that we do the right ones, and the ones that are going to give us the biggest bang for our buck. So planning is really important. Now, there's a lot of ways to think about capital expenditures. If we work if you work in a large corporation, one of the things you do is you do these kind of capital expenditure plans, as part of the budgeting processes. And it'll be so many dollars per year, and then allocate them to the projects that are the best. So one way to think about it in a farm is what's a reasonable number of kind of capital expenditures in terms of dollars per year that you want to look forward to, and then kind of consistently do that over time. There's pros and cons to that. The other approach is a little more opportunistic, and it's when there are good opportunities, we try and seize them. And there, again, another approach that's reasonable, but we want to make sure we're evaluating those opportunities, and that we're prioritizing the things that are really going to give us the biggest bang for our buck in the long term. And then the other thing I think to think about in terms of your capital expenditure plan is, the cycle or the stage of your farm. And so if we're in kind of a rapid growth mode, it's really important in that time frame to kind of map that out, so that as that business increases in size, we have the funds available to meet those needs. And then the other time I think that's really, really critical is that kind of retirement phase, thinking through those capital expenditure plans. And as you kind of near that retirement stage in your career is really, really important as well. So we want to start. We want to get you engaged a little bit with a poll, and just kind of see where everybody's at, and tell us where you're at in the capital expenditure planning process. And there's three options here. Don't know where to start. We kind of have an informal plan or have a very formal, probably written plan. Okay. So what we see here is that, we're about half and half between, boy, I know I need one, but I just have no clue where to start. Or, I have an informal plan. And I think that's not surprising to me that a lot of people are in one of those two stages. And what we want to do is help you get through that today and at least get you pointed in the right direction of where to start. And I always tell people it's one of the most important things you can do is, write those plans down, get them written out. You can always change them, but the magic occurs as you kind of put that pencil to paper, and it really helps cement that thinking in your mind.
And Brent, to build off what you just said, this is not something, I guess, everyone listening today and every producer thinks about their CapEx plans, right? We're not sharing sort of an earth-shattering idea here. Operators know this is important and they're thinking about it a lot of times. And the goal for today is to help them think more critically about it, sort of challenge what they have maybe informally, but then also encourage them to take the steps to start to formalize it. Because in some of the things we're going to show today, I think there's some real value to starting to formalize this. And so we spend a lot of time sort of ruminating on it in our minds. Well, let's take the next step and really create some value to this. To back up just a little bit, we're going to provide some background and some definitions before we dive into some specific steps. And so really, when we're talking about a CapEx plan, it's to think about these capital expenditures, and it's really, for the purpose of today's conversation, the question of when and how a business cash flows those capital assets. And why are capital expenditures, so important? Well, these are typically assets that have multiple years of use. And so we're making a decision to buy or lease today, or in 2021, and there's going to be implications that last for many, many years. And they're often very big ticket items. We're talking about pieces of equipment or farmland. These are going to be very substantial impacts to our balance sheets, but also maybe our income, but especially our cash flow statements. So a few examples to think about: machinery and equipment. This is the one that comes to our mind first. This is the one that people think about most frequently, but it could also include barns and facilities, especially if you're a livestock producer or you have a lot of grain storage on your operation. This could be part of that CapEx plan. And also maybe farmland that you own. That can be another big part of your capital X plan. And one of the key takeaways here from today's conversation is your farm has only so many resources that it can use, that it can generate to go towards family living or towards machinery or towards farmland. And so in a lot of cases, this is a bit of a balancing act. So when we're thinking about this, you might think very narrowly about, equipment, maybe the specific equipment for your row crop operation versus your livestock operation. But it's helpful to zoom out just a little bit and think about all of the capital expenditures and all the capital assets you need to be managing and replacing and upkeeping. And finally, we're going to focus today's conversation around cash flows. Last month or the month before, we had an entire webinar. I encourage you to watch that, about economic costs, accounting costs, and cash flows. And so there's a lot of ways that you can measure it. But for the purposes of today's conversation, a lot of the conversation around CapEx is going to be focused on cash flow. So what's the debt services that we need to manage this year and into the future? What are the outright purchases that we make without using debt financing? And of course, what are some of the machinery or equipment leases that we're on the hook for, that we have obligations for in the upcoming year? So we have 3 steps to help you get started. And the first step here is reviewing past activity. Again, kind of echoing what we talked about before, there's a lot of institutional knowledge. And so part of this is capturing what's happened in the past. And the past can be a really good starting point for making a plan. And so first off, what machinery and equipment does your farm use? You probably already have this as part of your asset sheets for your balance sheets, right? You probably already have a list. let's add a little more information to that. When did you purchase that current piece of equipment? Okay, that can be a really insightful piece of information for helping you think about, when do I need to replace this next one? And of course, you can start thinking back a couple combines ago, right? Has there been a natural rotation or a pace or a cadence to which your operation has been trying to upgrade or replace machinery over time? That can be a really helpful piece of information as you start to build your plan in the future. Again, this is something, this is part of the informal plan. If you're one of those 41% that said you had an informal plan, this is where a lot of your this is very much probably where you're spending most of your time. So start to capture that, and you can build off that in the future years. The second step is start to consider the cash flow. So once we look at the actual activity, let's add another layer of information, and we start considering the specific cash flows. So what are your annual CapEx cash flows? And we want to measure that with total debt service payments plus non-debt purchases. And included in there could also be those leases if you have machinery leases, but sort of try to capture that. And when possible, go back a few years, see if you can capture, 2021 is not done yet, so we should be able to capture that. What did you do last year? Maybe what did you do in 2019? Try to think back in time and capture as much as history as possible. And if that's hard, just start capturing it today and update it in 2022 and 2023. Your future self will really benefit from that. And I guess one level of this is capture it in total. And then the next step here is start to break it down. Start to break it down into individual pieces of equipment or individual pieces of farmland, so you can really start to keep a close eye on those rotations that might start to emerge. Now, this is sort of a high level way of thinking about it. But Brent, I'm going to flip this over to you now, and we have a specific ratio that producers might want to measure and follow with their operation.
Yeah, David, I think oftentimes we get ask questions of, is how much should I be doing for capital expenditure in a given year? I mean, if you're like a lot of us, we could probably defer almost all of it on a yearly basis, and the farm would still function, and we'd be just fine. At the same time, most of us don't want to get that far behind the curve. So people say, well, what's a reasonable number? Am I spending too much, or am I, not enough? And so one of those ratios that we can look at is called the replacement margin coverage ratio. And there's a lot of things on that equation. It looks complicated, but it's not really. At the top on the numerator, we just have the net farm income plus off farm income, and we add interest expenses and add back depreciation and subtract family living expenses. Now, what is that? That's just a measure of cash flow. So that's the cash inflows of the farm. And David had just been saying we're going to measure cash inflows and outflows. So that top is your cash inflows. And then the bottom is the interest expenses, the principal debt service that we have, and the cash that we had used for capital purchases already. So those are, cash outflows. And so you're basically just taking the ratio of your in to the out. And we want that number to be bigger than 1. And kind of a rough guide might be a red light, yellow light, green light thing is shown below, where, if they're right around 1, what's that mean? That means that pretty much all of our cash inflow is being used to, service our current debt and our current capital expenditures. And we don't like to see it that tight. Like to see that number, over ideally, over 1.5. So, just a way to kind of benchmark, calculate that for your farm. Go to your financial services officer, your lending officer, and discuss it with them. Have them help you calculate it, because as they're working on your finances over the year, they'll have all the information that you need to calculate this. So just encourage you to take a look at that and see how that's trended over time.
So for step 3, is sort of a forward-looking idea here. So we've sort of done a lot of back cataloging of information we had in the past, but now we want to look forward. Start to identify the priorities. What pieces of equipment need replaced or upgraded. Also think about those cash flows. What are your current and future cash flow obligations? Fixed expenses are really hard. They're not fun to calculate, but when you have a capital asset that you finance and there's a debt payment, we can actually forecast that out with a great amount of confidence for multiple years, right? So we should be able to look at this CapEx, look it out in the future, and know what those future obligations are. And as you start to do that, you're going to start to be able to identify bottlenecks or opportunities. And so we're going to flip over to an example here of how, if you put this together, you might be able to identify some of those. So this is an abridged or a condensed version of what you might have for your operation. So on the left, we've listed all the pieces of equipment. We listed the purchase year. And then we started to map out these cash flows that we talked about. And so we broke it out by individual piece of equipment. We added up in total. And as you can see, here's an operation that they bought a combine in 2013. They had debt on it through 2018. And I highlighted in blue, they're thinking, okay, should we replace this combine? Should we replace our tractor, or should we replace our planter? Again, this is a simplified example, but hopefully this is very valuable. You can take this and apply it to your operation. And so they have a few decisions to make here, but being able to map all of this out, they have a big picture here they can start to look at. So think about 2020, they bought a baler and they paid all cash for it. So here they are in 2021, and the only cash outflow obligation they have right now is this 180 acres. But also, by the way, this 180 acres is going to have no debt on it after 2022. So they can start to map this out a little bit and say, okay, how do we want to do this? Do we want to buy all three of these and finance them out? Do we want to buy one up front and not take on any debt and maybe wait a few more years? Can we push this combine and tractor and planter a couple more years? And so these are all the types of things that when you map that out, this starts to be a much more strategic decision, and you can really start to have some flexibility in thinking about how you want to deploy this.
Yeah, David, and we talked about this, and I just want to reiterate this because, like I said, I think this year you're going to see a lot of this activity. And one of the things, we did a webinar on the impact of this, where we covered the impact of that Section 179 and how that can kind of, or maybe that was growing on, but we showed an example of, how you can kind of get behind the curve on that if you depreciate 100%, finance 100%. So really lots of moving pieces, but David and I write a lot, and writing is hard, and it's hard to do. And David always tells me the hardest thing to do is start with a blank sheet of paper, because it's hard to get something on it. Well, I think it's the same way with planning and writing it down. It's hard to get started, but once you get started and get some numbers on the paper, you kind of say, oh, well, yeah, I can do this pretty easily. And I think, and to kind of wrap it up, capital expenditure, the planning is a balancing act. We all have limited resources. We all have lots of needs. And it's not surprising that, you'd hear two economists talking about trade-offs, and trade-offs are really kind of at the heart of economics. And I think capital expenditures are a great example of it. And what I often say when I see people say, well, I did this expansion, or I bought this land, or I did this, and I'm in tough financial shape now. Well, when we get down to the root cause of the problem, is not necessarily the actual investment that went bad. It was as much not planning for the investment, and then having a lot of other activities coming due at the same time, and that kind of gets you in a bad space. So the goal of our capital expenditure plan is to capture those known knowns, those things we know are coming. We want to avoid surprises, and allow us to search for those opportunities and do the things that really do add, the greatest amount to our bottom line.
So Brent, it's the part of the presentation where we get to bring in the lending expert. Chad, thank you so much for helping us put together this presentation today. Thank you for joining us. To kick it off, tell us a little bit about yourself.
My name is Chad Thue, and I've lived and worked in Northeast South Dakota my whole career. I'm coming up on 25 years here in January in agricultural lending, and currently live in Northeast South Dakota with my wife and 3 daughters. So.
Okay. Well, it seems like when we were putting this presentation together that I kind of laughed, because the place that producers are most likely to have this conversation about a CapEx plan is with their with their lender, right? So why is that the case? As a lender, tell us what the CapEx plan means to you.
Well, the CapEx plan is really important. I think throughout my career, CapEx is obviously a necessity, but it can also, get people in a tight financial situation as well. And I guess more than anything, they're going to probably discuss it with their lender because they need a loan for it, whether it be a tractor or a house or any type of machinery or land.
We mentioned earlier prioritizing needs and being a very important part of this CapEx plan. And you shared with us as we were preparing this a really neat and good way to think about prioritizing. Can you share that with us now?
Well, what I've been talking with my customers about every year is, not only keep a list like you said there, but also prioritize those and have those discussions with your lender. So I ask them at least, what's your top 5 capital expenditures that you feel may come in the next, 3 to 4 years. But they also need to think about, maybe 10 years or 15 years, depending on whether they're looking at buying some ground at some point. So, and it's a good conversation piece to make sure that you and your lender are on the same page. Because if you list 5 things and then they come to you throughout the year and they want to buy number 5, then that kind of generates some conversation of, okay, why are we looking at number 5 now instead of number 1? Because depending on your financial situation, if your cash flow is kind of tight, is 5 the right choice at this time, or do you need to wait for number 1 to come about? Because I think most farmers would agree there's salesmen constantly coming onto their farm and talking to them about a good deal. And I had a former boss tell me one time, how many good deals can you afford? So it's generated a good conversation, where we can talk about those top 5 and figure out what's the best way to go about it.
So to double click on that idea just a little bit, you have your producers not only tell you their 5 priorities, but then you have them rank in order 1, 2, 3, 4, and 5.
Correct.
That's a very good strategy, right? To really sort of force rank what is exactly those priorities and kind of allows us to prioritize our cash flow, but also those opportunities we had. So thank you for sharing that. So we've talked a lot about all the work that we got to put into this CapEx plan, and it's not easy, especially if we already have an informal plan in the back of our minds. Can you share some of the benefits that you've observed of having a CapEx plan that you can look into the future with?
Yeah, I had an example with a customer a few years back, as Brent had in his graph there. A lot of capital expenditures were completed in the 2012 to 2014 range, especially when commodity prices were higher. And I had a customer that they did that same thing. They upgraded their machinery pretty significantly at that time. But when I started working with them, I found out that they actually already had a long-term purchase agreement or rental purchase agreement with a landlord. It was a family friend, and they had already talked to him about wanting to purchase that ground and actually had an agreement in place. And that agreement stated that once the landlord passed away, they had 90 days to complete that land purchase. So when I started working with them, we talked about that and we looked at their current situation and their current cash flow and talked about, if you're going to get this land purchased, you need to make sure that you got your ducks in a row, to get that done when it comes. So every year when we looked at their renewal, we would, analyze their financial performance and figure out what their ability was to repay their current debt. And we discussed that if you were to purchase this ground right now, you don't actually have enough repayment capacity and your cash flow would be negative. So we talked about the importance of them working through those machinery purchases and not replacing every single one of them and trying to get those paid off before that land deal came about. And 3 years after we first started working together and 3 years of analyzing that, that individual did pass away. But they had worked through those machinery and equipment payments, and we were able to get that purchase financed for them. So very rewarding to have something like that work out as planned. So
yeah, that's a great example of the importance of that planning part, because the easy thing would have been to just kind of put it off and not really plan for it, and by planning for it, they were able to make it happen.
So I also want to take this, talk a little bit about the opportunities. And so with a CapEx plan, we always think about these bureaucracies or these governments that say, no, you can't do this because it's not in the plan. But inevitably, there's going to be emergencies or opportunities that come up. So how do you help producers think about having a CapEx plan, but also building in contingencies for emergencies and opportunities?
Well, I had an example one time that I actually kind of learned something through that as well. I was working with a borrower, and their cash flow was fairly tight. So our conversations had been, keep trying to work through these machinery debts that you have. And so they had held off on doing really any, capital purchases for several years. But they typically would replace their combine about every 4 to 5 years. And we got into the 6th year of them having the same combine, and all of a sudden I get a call, and they had just gotten into their first field of soybeans, and all of a sudden the combine went down on them. The hydraulics wouldn't work, and they couldn't even get up a hill or anything like that. Well, then they took it to the implement dealership, and they said they couldn't even look at it to fix it for 3 weeks. Well, they had about $2 million worth of crop in the field at the time, so they couldn't wait that long. So they ended up getting backed in a corner. At that point, you just got to find something. And they actually, if we had looked back and talked about that maybe a couple years earlier and had more discussion on that, I guess I would have talked with them about, okay, it looks like you're going to need an upgrade. So let's start looking at a public auction or like an online auction to try to get something that really fits your operation the best. But there wasn't time to do that at that point. So they probably spent about a third more on a combine than maybe they actually needed. So that was an example of, it's good to hold back when cash flow is tight, but those things are going to be needed at some point to be replaced.
Well, that's a great example. Thank you for sharing. Thank you for joining us. I think one thing that came to my mind is it's discipline, and it's a balancing act, right? You can't be too extreme to one side or the other. You have to strike a balance, and there's no cookie cutter answer. So appreciate your insights.
In terms of questions, I have a question about is there another ratio that kind of looks at repair costs versus depreciation costs? And I can't say off the top of my head that I know what those that ratio exists. One of the things I always encourage people, though, is say, well, if you're interested in it on your operation, one of the things you do is start digging into it and start looking at that, expense line over time and see how it has changed over time. The other thing I like to do is look at, there is a depreciation ratio that's really commonly used. You see that a lot. I honestly, I think it has, as it's applied, it's tough to benchmark because you don't know what accounting practice has led to those depreciation numbers. If everybody was doing economic depreciation, then it would be pretty meaningful. But with accounting, the changes can be so extreme from one operation to the other. I have people writing, really large write-offs off, and others not, nearly as aggressive. The other thing I would encourage people to do is we did a webinar on machinery costs. And the kind of at the heart of that webinar is the discussion of what's the trade-off between the cost of ownership and repairs, and how do you evaluate that. So we got a whole session on that. Take a look at that one.
In that webinar, we talked about the dirty five, right? So it's DIRTI, it's depreciation, interest, repairs, taxes, and insurance. And so if you want to really capture what your equipment costs are, you want to capture all those into a bucket. And so I think that's a good webinar for you to look into. And as Brent mentioned, it's this trade-off often between depreciation and repairs. And one of the benefits, I guess there's pros and cons to depreciation and repairs. One of the pros for depreciation is that it might be a little bit predictable. But one of the cons for repairs is that those can be lumpy and they can come as a surprise. And so you might think, oh, I'm kind of beating the average here. I'm doing really well on my repairs, and then something big happens. And so I think you just got to think about those as you're looking at specific pieces of machinery over a given period of time.
Yeah, I think that the key is really just tracking it over time and getting a good, a good system in place where you can track that stuff, or doing the work to kind of really sort it out. Because a lot of times, in the accounting system, it might all get dumped in and you don't really know what's driving some of those lines. So it's really just digging into your numbers. Another question about what about existing lease payments being added to the numerator of the ratio you shared with us? So that ratio, I said it was a kind of measure of cash inflows over cash outflows. In the numerator, I would include the interest expense on a lease payment. So that portion of it I would include in the numerator.
Traditionally, we see the lease is kind of already booked as in the expense side of that. So the interest is what Brent is talking about. So that's right. But the right question here is you want to make sure that you're thinking about those lease payments, because they're an important part of that. So you want to make sure you understand for your operation how that's being factored in there and how that's playing out.
Yeah. And I don't even remember if that ratio we showed had lease in the denominator either, but if it didn't, it should have included with the debt service lease payments.
Yeah, it needed to be included in there. Yeah.
I think it was written kind of generally, but yes, that's where the lease payments would be.
Well, that sounds great. And I do appreciate you guys all being online today. That'll do it for another episode of Two Economists and a Lender. So thank you to Brent, David, and Chad for leading today's conversation. Thank you in the audience for joining us. And we look forward to seeing you online again next month.